Okay guys, so this week our focus turns to the US dollar, and after a few grueling months of selling pressure, the dollar has finally seen some short-term upside this past week. Now the size and the pace of these moves were quite volatile, as we can see from this chart that the dollar index basically put up its best week going back all the way to the April market crash, and then of course before that going back all the way to 2016. So a monster week for the dollar. And the move was exacerbated by a couple of things like an overcrowded bearish position on the greenback, and was further helped along by another round of episodic risk off that we saw in the equity space as well. Now there were a couple of narratives that made sense of the dollar upside and the equity downside as well, such as concerns that fiscal stimulus in the US is still miles away, and a whole slew of Fed speakers that weren't as dovish and reassuring as the markets had hoped for. Now the dollar's inverse correlation with something like gold and the S&P 500 ramped up to pretty significant levels, which means that the downside we saw in gold and US equities basically mirrored the upside we saw in the US dollar. And the real question right now is whether this is a short-term squeeze or something more than that. Now, in this very handy chart above from Viraj Patel, we can see that a squeeze was inevitable. Is it a clear out before fresh short starts to build again, or is this a positioning reversal? Now, given that the Fed is still staying ultra dovish right now and keeping rates lower for longer, and since the reflation trade narrative is still very much alive right now, we currently hold the view that this falls into the squeeze category and a clear out category, as opposed to a full-on positioning reversal. Now, looking at the week ahead, the dollar's rally comes at a time when the US cannot really afford a stronger dollar. Now, even though the Fed has spent a lot of time, energy, and a lot of money as well trying to devalue the dollar recently, their recent communication this past week didn't deliver the assurance that markets wanted, especially with comments from Fed Chair Powell saying something like they've basically done all the things that they could think of. Now, that is really not the way that you try and keep markets calm and the dollar down. But despite their failure this week, as long as rates are in that lower for longer category, the US should remain weaker. But what happens to the rest of the world in terms of monetary, fiscal policy, as well as growth, will it be a very important consideration. Now, right now, it's too early to call this move, in our opinion, something more than a short squeeze. And once things start to calm down, we would expect the downtrend to continue. However, in the short term, there's a couple of risks this week that can see the dollar even squeeze higher, or maybe resume that medium to longer term bearish trend. The first one to watch, which will probably be the event of the week, is that first upcoming presidential debate between President Trump and Joe Biden. This is going to be a big one for markets. Nordea Investment Bank has often explained that what is good for the Donald, as in President Trump, is normally good for the dollar. Thus, if Trump wins the debate, so to speak, some participants are calling for dollar upside or further dollar upside. And if Biden takes the win, it's currently expected to be more dollar negative. Now, one of the reasons given for this is because Trump is normally more a protectionist in terms of his policies, which has in the past few years been a good input for the US dollar. So if markets do suspect that Biden's chances of winning is increasing, it might mean downside for the greenback. Now, even though that seems to be the consensus right now, the truth is that investors are just not sure how markets are going to react, with ING saying that the debate will give the markets a hint about how the dollar will fare in the run-up to the election. Now, after the debate, of course, the recent sell-off in equities will also be a key one to watch for the US dollar. That has given more impetus to that dollar run to the upside. So any further massive increases in volatility spikes that leads to further equity downside and sell-offs, that will be more supportive for the dollar. Vice versa, if we do see stock markets can finally eke out some stability this week, that should create some more of a pause in the dollar's recent rise. Now, the other risk to the dollar in the short term is the upcoming data. We have ISM manufacturing PMI, we have the ADP, we also have NFP on Friday. And even though economic data isn't really what it used to be in terms of the impact that we saw before the pandemic, it's still important, and another solid print should be more supportive for the dollar. And if we do start to see some misses coming into the US data, that will of course be more negative for the dollar. Finally, the other risk factor to keep in mind is US fiscal stimulus. Now, in a normal market environment, news of additional fiscal stimulus should normally be more positive for the currency. But on early Friday, we saw upside in risk assets and actually downside in the dollar when it seemed like a new stimulus bill might still be possible before the election. So any breakthrough between Democrats and Republicans on the stimulus front in trying to get that bill across the table should be more of a negative for the dollar and more of a positive for risk assets. All in all, it's going to be a little bit of a mixed bag of events this week, and we'll need to be able to stay focused, but more importantly, staying nimble in the markets as these events unfold throughout the week. Looking then at some potential sentiment shifts. Scenario 1, Biden 1, Trump 0. Now, even among Democrats, it seems like Joe Biden has his work cut out for him with this upcoming debates, as President Trump usually takes the show when it comes to these types of events. Now, that means a surprising victory here and successful debate from Joe Biden could cause a stir in the markets. And as mentioned previously, a win for Biden should tip the dollar scale lower. Now, for the highest probability trading opportunity, though, we would want to see multiple factors basically playing out the same way. That'll mean if we do see that happening, we would like to see equity markets finding some stability. We'd also like to see US data coming in softer than expected, and maybe even a possible breakthrough in terms of stimulus talks. And if that scenario plays out, we would expect the US dollar to sell off across the board. And something that has been hit very hard this past week by that surge in the dollar has been precious metal. So if we do see the dollar moving lower this week, that should be more of an upside factor for precious metals such as gold as well as silver. Scenario 2 is Trump takes the lead. So if President Trump mops the floor in the first debate, that would spark expectations that we might be seeing another 2016 scenario unfold, where Trump was behind in the polls like he is now, but still managed to snatch victory in the end. So due to that protectionist stance, that should be more positive for the dollar. For the highest conviction opportunity, once again, we will want to see all of the factors basically playing in to a stronger dollar. That'll mean upside surprises in terms of US data, a breakdown in terms of stimulus talks, and in terms of the overall equity market, seeing a further massive risk of flow coming into the markets. Now, if that happens, we should expect strength for the dollar across the board, and also seeing more downside in things like equities as well as precious metals. Now, right now, the conviction level among analysts for the dollar and equities, how they should react going into the election and going into these debates, as we said, it seems far from convincing. So that means that the outcome of how the debate will affect the dollar is not a done deal at this stage, and some participants would probably want to keep positioning very light going into that event. So from a risk management point of view, there is nothing wrong in staying out of the market to see how the dollar and the other markets react first before we make our moves in the week ahead.